Hello, welcome. Thank you everyone for joining us. I'm Kate Valentine. I'm so glad that you've decided to join for this webinar today. This is one of the most exciting topics that I get to talk with sellers and business owners about. I absolutely love hearing the stories of you guys building your company and getting it to this point ready to sell. So all month on our Extras podcast, you've been hearing from the managing partners of Global Wired Advisors. You're going to be hearing from them in just a minute. Joe, Chris, Jason, and Chris, all of them are going to be talking about the selling process from start to finish. And if you miss any of today's webinar, we are going to be recording it, and then we'll send out that recording later this week. We are going to have some time for questions at the very end of the webinar. You can go ahead, send any questions that you have during the webinar in the chat. I will save them and make sure that they are asked at the very end. Again, thank you for joining us. And I'll turn all the time now over to the guys at Global Wired Advisors.
Hey, Kate, how are you?
I'm doing great. Thanks, guys.
It's great to be on. It's great to have an opportunity to talk to Keyword and and all of your audience today. We have a pretty good presentation, and I think it's going to be very valuable for the folks out there that are interested in exploring a sale, exploring exiting an Amazon business that they've built. All right, so just as an overview, we're going to give you a quick introduction of who we are, what we do. We're going to go through the business sale process, the key steps. We're also going to talk about some misconceptions that a lot of people have about selling their business. And we're going to go into who buys Amazon business. There are a lot of people out there, I'm sure, that are wondering, gosh, who are the typical buyers for an Amazon business? We're going to talk about that. And then at the end, we're going to go through really the steps that are necessary to maximize the value of what you've built in a sale. And as Kate mentioned, we'll follow that up with some Q&A. Okay, so Global Wired Advisors, who are we? Really, you can think of us as an investment bank for e-commerce businesses. And what do we mean by that? Well, really, it's a combination of two separate unique skill sets. We found that there really was not a lot of resident core investment banking expertise in the online world. So, what we did with the Global Wired platform is we combined very deep in structured finance, investment banking expertise with digitally native expertise to put together the right approach to helping people that have online businesses go through the sale process. And we're not focused exclusively on sales. We can help with a multitude of other transactions, mergers and acquisitions, divestitures, capital raises, things of the such. I won't go into each one of our individual backgrounds. I'll just again say that most of our histories are through bulge bracket, large investment banks. You can of course find us online on LinkedIn. I will say that as we go through the presentation, we are going to jump in and out of this chair. So I'm in the chair now. So next you'll hear from Chris Bodnar, one of our partners, and then Jason Somerville, and then Chris Schifferling will be staying here and adding commentary as we go. And you, Kate, of course, will be moderating. All right. So understanding the business sale process. Actually, there we go. Perfect. So really, the first step in the sale process is a reorientation of your thinking. You have to make an internal switch from growing your business in a way, worrying about your business, focusing on how you're going to be successful with your business, to thinking about how a new owner is going to do the same. You have to make the switch from growing, again, what you built to being able to very succinctly describe how your business is going to go on without you. And many sellers that come to us, they're very inclined to focus on a lot of the things that they've done in the past, the milestones, the increases in revenue and whatnot. And buyers are really much more interested in what your company is going to do in the future as opposed to what it's done in the past. So having a go-forward plan and having the details of what that go forward picture looks like is very important. Okay, so documentation is key. Really, the first step in the business sale process is accurate historical financials going back 2 to 3 years or to inception. A lot of people use QuickBooks. This is fantastic. Most buyers of business are expecting QuickBooks files. It's not necessary. We've seen financials that have been put together in Excel format. The key, though, is to make sure that they tie to bank statements, that they tie to actual transactions that have gone through a financial institution. That step, accurate historical financials, is really the stake in the ground. The first step to pulling together, again, that picture of your company. The next is descriptive information about what we refer to as really competitive advantage intangibles. And those things are going to be like brand loyalty, product innovation, your pricing power with vendors, things that help you succeed in growing sales and taking market share. The next thing that is really necessary is a calculation of cash flow or seller discretionary earnings. So seller discretionary earnings can be thought of really as a recasting of your profit and loss statement to reflect items, expense items that are one-time or unique to you as an owner. So, for instance, your salary. Your salary is something that a new owner might not necessarily need. Let's say you made a capital improvement to your company in some way. That is a one-time expense that would not be ongoing. Those are things that would be added back to give a new owner really a good feel for what the cash flow is going to be of your business. Next thing is financial projection. You know, financial projections are very important, and a lot of sellers are kind of inclined to just say, hey, I think someone could grow this business by 10 or 15%, and that's really not good enough. The projection process should be based on a lot of the intangibles that we just spoke about. They should be based on specific product projections. They should be based on the markets that you're active in and what those markets are going to do. And they should be very well thought out because, again, as I mentioned before, buyers are interested in what your company is going to do going forward. Another thing to consider is potential impacts from industry-specific items and macroeconomic variables. Is your industry shrinking? Is it growing? What is your competitive spot on the board in your industry? Where are we in the business cycle? These are all things that should be included in the business sale process. All right, very important slide. In going to market, it is highly recommended that you engage a qualified mergers and acquisition advisor. They run the deal process for you. They help you pull together the necessary pieces to really tell the story about your company, to show a new buyer what your company can do. As you can imagine, this is a fairly involved process when it's done correctly. And if you have a company that people are going to be interested in acquiring, there could be a lot of inquiry. So this could be very distracting. And a qualified M&A advisor can handle this process for you and streamline it so that you don't have to take your eye off of managing your company. And, you know, we see this from time to time, and it's unfortunate, but in the sale process, if you take your eye off the ball, if you take the attitude, hey, I'm selling what I've built, I just need to get to the finish line in your performance lags, that can really impact a sale. Buyers want to see tailwind. They want to see go forward performance. So, you know, an M&A advisor will keep you on track to make sure that you don't take your eye off the ball with respect to that. The Global Wired Advisors approach is really designed to keep you on track, is really designed to take you through the necessary steps that are required to put together a very succinct package that describes your business to the market in a very informed way. We sit down first with you and we go through what your goals are, what your timeline is, and we pull together something called an offering memorandum, which highlights all of the important aspects of your company, its operating model, the products that you sell, its history, your history, and of course your financials. All right, so going to market. Once we have your package put together, the first step that we do is the teaser blast, and the teaser blast is really just an introduction of your company to the world. And the teaser is really just a very short, succinct description of your company without the name. We put in financials, we put in a brief history of what you've built, and we send it out to our network, which right now includes over 64,000 people in different countries. And we introduce the concept of your company to that audience to give them a feel for what this opportunity will be. What does that produce? Well, that produces inquiries back into us about the opportunity that we just sent out. We get a feel based on that teaser blast where people will be with respect to your company. How will they be inclined to pursue your company? Are we getting a lot of inquiry? That's a great sign. That means that the market, the quote-unquote market for your company, is quite big. If we're not getting as much interest as before, then we may need to tweak some things. But the teaser blast really gives us that first good indication of where your company is probably going to sell. Non-disclosure agreement, very important. We take confidentiality very seriously, and before we send out any material that we've put together about your company, we have every individual or company inquiring about your company to sign a non-disclosure agreement. The non-disclosure agreement is a way of protecting your intellectual property, the specifics of your business model. Your name will be disclosed, so we don't want anyone disclosing the fact that your company is for sale. It also protects your employees. There's a clause in there to make sure that no one can solicit employees once they find out about your company. And this step is really necessary to make sure that everything that you've built is protected legally. All right. So with an NDA in place with a potential inquirer, we're able to distribute the offering memorandum. And again, the offering memorandum is going to have a lot of detailed information about your company presented in a very succinct way to give a potential acquirer all of the information that they need to provide a value and a structure on how they want to ultimately purchase your company. We tell the story. We tell the story about your company effectively, and we answer questions that people are going to have as they read through that document. And again, this is where the value of a qualified M&A advisor is it's so important to have one, because you can imagine that when these OMs go out, there are a lot of questions potentially. There's hopefully a lot of interest and a lot of questions, and we handle most of those for you. Once we have solid inquiry, we determine really who the best buyers are likely to be. This is going to be people that are going to have the highest enterprise value as an offer and the best deal structure. And there are so many different types of deal structures. I don't want to go into all of them. Some deal structures are based entirely on equity, cash up front. Some deal structures require financing from a bank. Some deal structures would require a seller's note plus financing from a bank plus equity. There are a myriad of different structures, and we can help you decipher what the best structures would be. All right, so once we have zeroed in on who the likely suitors are, we're going to schedule meetings with you as the seller to talk to them. They're definitely going to want to talk to you. We will go through that process with you beforehand. We will rehearse, what to say, what not to say, just to make sure that, again, we make the best presentation with potential buyers. And once we've narrowed the field down further, we'll help you negotiate with interested parties to make sure that you do, in fact, get the best enterprise value and the highest deal structure. And of course, we'll help you through the entire closing process. So you can really take on what's next. And you know what we found is that a lot of people that have built successful Amazon-based businesses get tired. You know, it can be quite exhausting, and you know they need a break. And we'll take them through the sale process. They'll get a break. They'll do a lot of the things that they haven't had a chance to do while they were building their business, and then they'll get bored again. Then they'll be looking to really get back in the game and to start another business, and we can help with that as well. You know, we talk to so many different sellers that it makes a world of sense to stay in contact with us, because we can certainly introduce you to people that are just coming online to sell their businesses. So, okay.
Awesome.
Well, yeah,
we're going to hand it over to Chris Bodnar, who's going to walk us through the 5 misconceptions to selling your business, because one of the things that we do run into is the myths about selling your business. And so Mr. Bodnar is here to dispel those myths today.
Thanks. Good afternoon to you, Kate, and to all of your viewers as well. We've gotten to know some of you along the way already, and it's nice to join you today. I thought it would be helpful if many of you hadn't heard the podcast previously, to just sort of revisit some of those misconceptions that we went through on that podcast. We highlighted 5 of them in particular. And, the first one was that my company needs to be perfect before selling. And, the right way to think about this is that you really need to have everything that's mission critical to the company in place before you take your business to market. But most buyers want to understand and believe that what they're buying from you is something that they can run with, and that there's still meat on the bone there that they can do something with after they acquire it. So, that's part of what we do when we take your business to market. And a lot of what I'm going to be describing is sort of adding on and complementing what Joe's already shared. But that's part of selling the opportunity. So it doesn't need to be perfect before selling. The second is, I already know what my company's worth. And, if, as you can imagine, your company isn't like unless it's a publicly traded company, which most Amazon businesses that we come across aren't. There's no stock ticker flashing in front of the screen with a deep, pool of buyers and sellers at the market. What's really needed is to go through a full marketing process to understand what the market has to say about what your company's worth. We have a good sense of what that is from our experience with it from day to day, but it's only through going through the process that we really understand what that company value truly is to you. That third myth that we went over on the podcast was that, I'll be able to sell my business at the specific time of my choosing. And, when things are going really well, it's easy to look out into the future and say, yeah, not yet. And, while that may be the right decision, we find that the best outcomes occur when opportunity actually meets good preparation. So what's important is actually to have a plan in place and to prepare. And being in touch with good M&A advisors is a key piece of that, to understand timing and how that fits with your timing, to be able to do it and to seize the right opportunity. You're only really going to know in hindsight unless you're working with professionals who understand markets. So then there was that fourth one, if you could see on your screen, that a lot of people believe that the CPA or the attorney is the best party to use to sell the company. And remember, we talked about how each one plays a role in the transaction, but each one, the CPA and the attorney, aren't making their living by being in touch with market participants, with actually selling companies on a day-to-day basis. each has an important part of the deal team, no question at all, and each will help with your interests as an owner. But as Joe went through, the highlights of the process, it's very deep and it's very detailed, and it's very important that each one does their specific role to make sure that they're bringing the best outcome for you as the owner. And then that last one that oftentimes I think we speak to a lot of potential clients who believe that, doing it themselves is the best way that they can maximize their own outcomes. And, the best thing that you can possibly do as a business owner is to keep running that company like you're never going to sell it. Because every single buyer that we're going to talk to out there on your behalf is going to want you to be doing that right now. And so, don't take your hands off the wheel. Don't take your eye off the ball and stop what you're doing. They want to believe that they are acquiring an asset that they'll be able to take into the future and that's running and finely tuned. So, going back to one of those myths, what does it take to really be ready? Where opportunity meets good preparation. There's some steps that you can actually take now to either be ready if you're thinking about an exit in the next, call it 6 to 12 months, or to become ready if in the next, if your time frame potentially is further out than that. And that first step I think you want to do is to look at your ownership structure and consult your partners. For many of you, you might be a sole proprietor. So, having that meeting, that sit down really isn't too complicated, but you still want to be thinking about it because many people who we talk to, they have family involved, or they have other non-related partners in their business, in the equity of the company. And you want to have discussions. Are there any things that have changed in your personal situation? We find that personal factors are actually one of the key drivers that create the impetus to actually do a transaction. Joe mentioned earlier that maybe you've become bored at what you're doing or with the business that you're operating. Maybe there's a health concern. Perhaps your partner is having trouble in his marriage or her marriage. Those type of things are real life issues, and they absolutely weigh on the decision of whether or not to sell the company. And while maybe you don't have those conversations on a daily basis as you're operating and making the sausage, as they say, from day to day, but you'll be glad that you did, because the most important thing as you go through the M&A process is to make sure that you're on the same page and you're working toward the same goal. The second thing that you could do, Joe touched on some of these things, is you really want to do a very good corporate review and analysis. You want to make sure that, your financial house is in order, so to speak. You want to make sure that if you have those financial statements, they tie out to other key pieces of information, like your Seller Central account, or like if you have a Stripe account or other types of payment processors, or even against your tax documents. But we often say that a shrewd buyer is going to be looking at all these things in time as well. And you don't want your sins to find you out, in a sense. You want to make sure that you have all of that in order before we go to market. Another thing you can consider is, have you been managing your inventory levels too conservatively or possibly too aggressively? And what type of a situation is that putting you in from a cash perspective? Or what is that, what has that made the profile of your company look like? And then lastly, perhaps you want to give some thought to the contracts that you have in place. If you work with a third-party logistics provider, or if you have certain supplier arrangements or manufacturers, if there's any kind of a lease that you have that you need to potentially negotiate. Those things are all important things that you could be doing right now. And then lastly, number 3, I think being in touch with a qualified, experienced M&A advisor is something that you should be doing all along. We talk with clients who actually like to do that on a quarterly or a half-yearly basis. One of the reasons why is because they like to, because of their operating agreement states that they need to have a fresh valuation always in place. Another reason why is because you can understand what's the conditions that we're seeing in the market, and there's other information that can come out because a good M&A advisor is really part of your team. And as we get to know you, as we get to know our clients, what we find is that we have a very good rapport with our clients. And as we see conditions in the market, we're able to contextualize that in terms of what's, how that relates specifically to them. And it's easy to think that when you sell your business, it's really just a technical and financial process. It's an exercise in just throwing together financials and trying to get a number. And I think anything, couldn't be further from the truth, because there truly is an art in the process of selling a company. And, one thing that we find, having, forged for all of us 20 plus years each in careers in investment banking, that there's a whole bunch of factors that come to bear. And it's a lot like the difference between being a cook and being a really good chef. You have to understand what it is that you're working with to be able to bring those factors into play with the current opportunity. And so one is timing. What are the macroeconomic factors that are weighing on markets right now? What are the things that are impacting small business sentiment? What are things, we have relationships inside small and large commercial banks where we have the opportunity to speak with their credit officers and understand how credit policy is changing. That's something that's very important if you think about the fact that many businesses are financed when they're acquired. So, timing is a very important part of understanding the process. When, just last July, we put out a white paper that discussed small business sentiment and related that to the time of the current economic expansion and how we've gone the furthest distance we have in an expansion without a recession. I don't know when a recession may come, but when you compare sentiment then to sentiment now, we're starting to see a pullback. And so understanding timing and how to relate that all to our client situation is very important. The next thing that's important, I think an important part of the art of selling a company is how you frame the opportunity. When we have discussions with parties that we go out to, that network of, there's literally thousands upon thousands of parties depending on the opportunity, we have the chance to understand what they're looking for. And something we never do is we never impose a value on someone, on a buyer, because what they understand to be true about their situation is very unique. And oftentimes, if we were to tell them what they should be thinking about paying, may end up being lower than they would pay you for the value of your company. So what we like to do is we like to frame the opportunity in terms of, what is it that they can take from what you've already built and run with? How does that factor into the things that they're trying to do? If it's a private equity firm that's building a portfolio of digital assets, if they have a certain focus when it comes to various consumer brands, we have the ability to really sell you and to sell the things that are important about your company that you've built. And then lastly, I would say that how we present that opportunity to the market is equally important. I think that we like to go out and make sure that we pitch the opportunity in the right way. Everything that we do is done to the uttermost. It's always done with the most professional presentation possible. It's done with the air that this is the most important opportunity that a buyer could be paying attention to at any one time. Mm-hmm. And I think the way that has an influence on them is that we influence them in a way that makes them want what we're selling. And these are all things that a qualified and a successful M&A firm should be able to do for you when it comes time to sell.
That's right. Awesome. Thank you, Chris. Appreciate that. Sure. Next up is who buys these businesses? It's a question that we get a lot. when we're all of us on the phone with potential clients, it's definitely one of the top questions is who buys these. So today, Jason is going to show us the Wizard of Oz and who buys these businesses.
That's right. We have a curtain. Actually, we don't have a curtain. Right. But next time, curtain. Well, I want to say hello to everyone. I'm Jason Somerville, and hello to Kate, and thanks for hosting us. Chris is right. One of the most frequent questions that we get from our clients and potential clients is really who are the types of counterparties and people out there that are buying Amazon businesses. And really the answer to the question, as the slide says, is that that's been evolving and changing since about 2015. So I use 2015 because that's when we really started to see any real activity in terms of secondary market trading in Amazon-based businesses. And, just for sake of this discussion, when we say Amazon-based businesses, the way the market tends to treat a business as being really Amazon-centric is if, more than 50% of their sales come from the Amazon sales channel. So prior to 2015, really there was a feeling in the market, there was, I think, a lot of uncertainty with respect to the opinion around Amazon, its longevity, what was it going to be, how long was it going to last, how is it going to develop, and what were the risks to these businesses that were being created, really in a large part solely to take advantage of the sales channel, the Amazon marketplace that had been built. Across the bottom of the slide, you see a few different categories that we're going to get into a little more deeply in a minute or two. But the real truth is, this market is rapidly changing. It's rapidly growing. It's very dynamic, and it has become a market that in 2015 was relatively non-existent. And in 2017 and 2018, there was, well north of $300 million or more worth of transactions executed in the marketplace. So just to give you a little idea, the acquire universe for Amazon businesses is almost as broad and varied as the Amazon universe itself. And really what I mean by that is, while there are roughly 2 million sellers, I think is the count that I've heard, most recently on Amazon. And all of those sellers are different and unique in their own way in terms of the products that they sell. Are they reselling? Are they branded? What are the categories? What are the industries? So on and so forth. And the Amazon buyer universe ends up being segmented in many ways across a lot of those same metrics that differentiate one business on Amazon from another. Things like product category, history, how long the business has been around, the supply source, is it domestic, is it international, SKU count. Some buyers look for businesses with lots and lots of SKUs for diversification. Other buyers really like a tight SKU count, a kind of a very focused strategy. Branding is another big one, which we'll get into more in a moment. Where are you, how are you branding? Are you branding outside of Amazon? Are you building a brand that's becoming recognized in its own right? Or is it really just kind of a brand built for Amazon that could never really be anything other than that? So the buyer universe tends to be segmented across different categories and is very, very broad and diverse in its own right. So, but I kind of alluded to this on the prior slide, that the consistent theme is that the base is growing, it's diversifying, and this is a key one, it's getting smarter about analyzing the prospects for Amazon businesses. As this market has gotten a lot bigger and there's been a lot more activity, the buyer universe has gotten much more educated about the risks and rewards of an Amazon business. So one thing that I think is important to point out is that as this market has developed and grown, it's really become what we would say is a real M&A type of a market. Now then there's north of $300 million worth of transactions being executed on an annual basis. It's now more mainstream, which really means that it behaves like a more mainstream market. It's affected in the way traditional M&A markets are affected by some of the things that Chris Bodnar actually mentioned earlier, which we'll get into in a moment as well. Whether that be macroeconomic factors, both domestically here in the United States as well as throughout the world. It's not kind of its own little niche market that's kind of insulated from all the things that the larger, more developed markets are subject to. It's now subject to all those things as well, which is important, knowing that if you're an Amazon business owner and you're trying to understand the kinds of things that will affect the value for your business and the timing around when to sell. So some of these macroeconomic factors, which may or may not be Greek to you guys out there, GDP, gross domestic product, that's really, just the general overall economic environment, whether it's in the United States or another country. Is the economy growing? Is the economic, outlook positive? Or are you starting to get into a recessionary type of environment? Interest rates are very key. They drive a lot of things in financial markets, the cost of financing being, one of the main ones. But, usually interest rates are a kind of a bellwether and an indicator of what's going on broadly economically. Consumer confidence, very important. Obviously in Amazon businesses, which are very consumer product centric, very essentially in the retail world. So, and small business optimism as well, which Chris mentioned. So the other thing that I think is key to point out, which is somewhat timely, given that Mr. Bezos announced that he'll be getting a divorce, is the fact that Amazon-centric developments will affect the acquisition market for Amazon businesses, positively or negatively. So, things that Amazon does that have an effect on a lot of sellers will have an effect on valuation, on the sale environment, the risk profile as determined by the buyer world. Anything that those guys do that is, again, positive or negative that will affect your business, believe that those who are looking to acquire businesses will be very, keen on understanding that. They'll be monitoring those things and trying to determine not only how things that have been announced will affect the business going forward, but they'll be trying to play fortune teller and decide, well, what's the next move? What are the tea leaves saying about, things that might change, whether it be referral fee structures or, how aggressively Amazon might go after the business of a lot of its resellers that we see. Things like that are Amazon centric. Those all play a part now in the market for selling your Amazon business. So I'm going to quickly go through this. This could be, we could do an hour on this one slide. So I'm going to try to be brief, but I'm going to give you just a quick little overview of some examples of how these different buyer types look at the world and the things that they tend to focus on. Very quickly, individual buyers of Amazon businesses, tend to be individual people, occasionally a two-person buyer group or something like that. But, really think mostly individuals who have the capital to go out and buy an Amazon business. What they're looking for primarily are, they're looking for cash flow stability. And depending on whether they plan to operate the business themselves or treat it even kind of almost like a hobby business as a secondary source of income, will affect how they view valuation and interest levels. So but you could have two buyers with very different plans for a given business and ultimately, have very different views of value. But the other thing that's rather important to individuals that we see is, is this a business that I can finance, often through the Small Business Administration program or some other traditional financing source. Investment groups, what I mean here is kind of loosely formed investment groups, search funds, things like that. They often kind of play in the $300,000 to $700,000, enterprise value price range. Again, they're looking to loosely pool capital and buy a business as an investment. So they would want to install an executive to run it or a general manager. Family offices and private equity groups, I'm going to lump those two together for the sake of this discussion. There are some differences there, but primarily, they're really viewed as kind of more the traditional kind of super professional investor that's looking for larger businesses with a clear growth strategy. Branding's important. And oftentimes what's important is, does the business fit within their existing portfolio? Strategic buyers, they're really looking for something that fits within their existing business. So, for example, if you have a baby products company, whether they sell through Amazon, through a website, or both, and they're looking to build on their portfolio, and you happen to have a nice Amazon business that sells and focuses on baby products, that would be a good example of where they would want to acquire, be interested in acquiring you as a strategic acquisition. And lastly, aggregators, which are new really in the space over the last, call it 12 to 16 months. These are companies and capital really pools that have been formed primarily to go out and purchase large numbers of Amazon businesses, aggregate those businesses together, oftentimes with the idea that eventually they will take that platform public and sell public equity to raise additional capital. So again, there's a lot there, and we could go on quite a bit, but that just hopefully gives you a little bit of an idea of just some differences among buyer types. I'm going to actually go on to the next slide and just talk a little bit about the future. I think, from our standpoint, there's a couple key things that we think were worth bringing up as far as what we see in 2019 and beyond. Number one, we believe that the acquire universe and how acquirers behave will continue to evolve. I think that this is, again, a dynamic market that is going to continue to change over time, both from a buyer perspective and a seller perspective. It'll be something that continues to move around a little bit, and I think the buyers will continue to get smarter, continue to understand the landscape better. Risk profiles will get a little more refined. As the acquirers become increasingly savvy, the pure momentum buying will cease, and Amazon businesses that are differentiated will be the most attractive. What I mean by that, what we saw in 2016 and 2017 in particular, were a lot of Amazon businesses being sold just because they were related to Amazon, and because Amazon had a lot of momentum as an overall entity and really as a theme. And so a lot of businesses traded based purely on that. Well, a lot of very uneducated buyers bought those businesses and found that what they purchased was a little different than what they thought they were getting. And as the market has grown, the buyer world has gotten smarter. And what they're looking for now are businesses that are differentiated in some way. So that doesn't mean there won't be a large acquirer base. What it does mean is you'll start to see bifurcation, and we're already seeing it, where the really good businesses, in terms of kind of the definition many larger buyers would assign to that, we'll see increasingly higher and higher multiples, in terms of valuation, whereas businesses that aren't as differentiated will sort of stagnate with respect to the multiples that they're likely to see. And then I think the success or possibly lack thereof, of the larger investors and the aggregators will weigh heavily on the market, because that is a new concept, and there are a lot of large capital pools hovering around the idea of doing exactly that and aggregating, large numbers of Amazon businesses and consolidating them together. So if the entities that are already doing that experience good success in the short run, you'll see more of those capital pools being put together, and it'll be more copycat type aggregators that come to market. And then lastly, I mentioned before, buyers will continue to monitor Amazon's overall performance and strategy closely, and it'll be a major factor in the acquisition market for Amazon businesses. Again, if Amazon has a bad quarter overall, If Amazon has poor guidance, if Amazon looks like it's losing momentum, as it kind of overall, that will have an effect on the acquisition market for these businesses. So I think the next thing we're going to do is kind of go in through a final section here, getting a little more specific around maximizing value. So Joe Hogg's actually going to come back in here, and we'll finish up before a little Q&A.
That's right. Yeah, come over here. I'll go.
Do some musical chairs here
Yeah,
for our
right.
audience.
All right. All right. All right. So, maximizing value in a sale. Really, in order to accomplish that, you need to understand the process and you need to understand the market. Everything that we've spoken about today is designed to educate you, to get you to a point where you're going to be the most successful in going through the sale process. Really knowing the steps, understanding the market, understanding what you've built. The key too is to understand that this is not static. This will change. Every 3 to 5 years, the market for what you have built will be different. Economic variables will change. The industry that you operate in will change. Your competitive position in the industry could shift. We could see in general business multiples, online business multiples contract or expand. So it is somewhat of a movable feast. Careful planning is required. Careful planning to go through the sale process. You really can't just stumble into it and expect a good outcome. It requires a well thought out, well planned approach. And it really requires you to start thinking about doing that process 6 months to a year in advance, because it is fairly involved. Go to the next slide. So maximizing value in a sale. Well, it really comes down oftentimes to identifying and optimizing the key attributes of your business. Yearly sales trends. Yearly sales trends can have a lot of nuances. There's seasonality in sales trends. It's important that you understand how these sales trends can shift, and important to be able to explain them to a potential buyer. The customer mix and profile. Who is your customer base? What is their demographic? Are they stable? Are they shifting? There are a number of nuances there that need to be understood as well. Marketing plan and potential force multipliers. So every company needs to have a go-to-market strategy. Who you are, what you do, what is your market, and how you take yourself, your company, to market. Oftentimes we find that there are a number of different marketing channels that have not been tapped. People, for whatever reason, lack of funds or just an inclination to not tap a given channel, have not explored that channel. And oftentimes this is what we refer to as a force multiplier, because when we pour marketing dollars into these channels, we can see a quick acceleration in sales, and buyers will be especially interested in knowing those force multipliers. Brand loyalty, product differentiation, product innovation, all important, all key. How quickly do you change products? How quickly can you change products? How differentiated are your products? It goes back to seasonality, barriers to competitive entry. You know, how deep is the moat around your existing business? How easy is it for competitors to reproduce what you've put together? Vendor relationships, pricing power with vendors. Do you have multiple vendors? Are you beholden to one particular vendor? Management information systems. Some of the most successful business sales that we have seen sellers have actually put together a separate management information system platform where they're mining just troves of data from Seller Central, and they're using that data to help inform their business. I'll hold off on the last bullet point. All of these bullet points together really speak to one key important thing that needs to be expressed, and that is margins, gross margins. All of these items are important in helping you maintain the gross margin of your business, the difference, in short, between what you're making revenue and the cost of what you're selling, cost of goods sold. critically important to being successful online because margins can oftentimes be quite thin. Buyers are going to want to know that your margins are stable, or you can increase them, you can expand them through these factors. The last bullet point, the transferability of the management model. What you have built, what you have put together, needs to be transferred. It needs to be expressed in a way that a new buyer fully understands how to operate the machine that you've put together. The most successful sales that we've seen have this key element. They have a succinct plan on what the go-forward operating model of the company is. They've identified all of these key attributes, and if they have not optimized them already, they have put in place ideas about how they would be optimized going forward. All right, so we've talked about why it's important to optimize these attributes. All of these optimized attributes would be included in the offering material that we would put together and taking you to market. This last point is very important as well. Many times people will make the decision to sell their company, and they'll view the sale process as just reaching the finish line. You cannot have that attitude. It's important that as you go through these steps, you charge through the finish line. Buyers can really sense the go-forward nature of what you've built. And if you start petering out, prior to reaching the finish line, then first, your performance will probably suffer. And second, there won't be a great deal of enthusiasm for a new buyer coming in. New buyers can tell. They can get a real feel for whether or not, again, there's going to be tailwind in what you do. All right, so achieving top value. It doesn't happen by luck. It doesn't happen by luck. Many times sellers will say, hey, I'm just going to list my business, and I think I'm just going to see what I can get. Most of the time that does not lead to an achievement of the best value that your company will trade for. It really takes focus. It really takes an understanding of the process and of the market in going through the steps that we've laid out. We found that when people do that, oftentimes their companies will be chased. Oftentimes there'll be multiple suitors, and they will bid through offering levels, or if it's an auction process, they'll bid through expectations. So succinct business plans, well thought out business models, memorialized in OMs, requires a great deal of work. Again, it's not by luck, usually results in success. Another point, something that we've seen that has also been successful is when a seller will offer to help a new buyer get started, either through a consulting agreement or through a period of time where, again, they will help them transfer what they've successfully built. And, again, it goes back to tailwind. Buyers really appreciate that. So in short, being successful in selling your company, maximizing its value, it's all about succinctly telling the story, showing the details, showing buyers the vision of what will be going forward. And you can't really do that if your attitude sort of diminishes toward the end. You can't really do that if you don't have the details that are required to be put together in OM. You can't really do that if you don't have a good understanding of the process or of the market. The vision is everything. So that concludes our presentation today. I think, I think there's probably never been a more exciting time to be involved in the Amazon space. There's so many examples that we can think of where people have made terrific sums of money in such short periods of time, building successful businesses and taking them through the sale process. So I guess at this point, Kate, if we want to open up the lines for any questions, that'd be great.
And I've been collecting a lot of questions throughout the presentation, and props to everyone who's been here contributing questions. There's some really good ones. So we did cover, April asked a question early on, do you have buyers looking for Amazon businesses? I'm going to just quickly answer yes. Yeah. Anything more you guys want to add on that one, or should I just keep moving through these?
Well, there are always going to be buyers that are interested in finding the right Amazon business to fit their given circumstance. And Jason went through the list of different buyers, and every buyer has a different motivation. So I guess I'll just end that by saying that there are plenty of buyers for all sorts of Amazon businesses.
And our next question is going to be from Rika, and I'm sorry if that is not how you pronounce your name, but does the goodwill, the seller feedback that you get, does that transfer to a new owner when you sell your Amazon business?
Yeah, I'll take that one. Yeah, the answer is yes. When the account is transferred, all the history of the account, all the seller feedback, all of the reviews, et cetera, get transferred with it.
Okay. Next one, do you guys only sell Amazon businesses, or do you sell other e-commerce businesses too? This is from Bill.
We do. We cover the entire digital space. So we're not unique just to Amazon. So anything that you have online, anything that's digitally native, we can certainly handle for you.
And our next question comes again from Rika. How to best identify potential buyers? We covered that with Joe, and that's also, if you want even more info, in our episode 2 that we did with you guys a couple weeks ago. Rika, I could send that to you as well, but there's several different buyers based on kind of where your company is valuation-wise. Next one from Tala. Do you help with litigation if someone breaches confidence, that NDA? That's when he asked this question.
Well, we can, and that's very serious. That's a very serious thing. What we would probably do in that case is refer you to the right attorney to help you handle that issue.
Yeah, and we have a number of attorneys that we work with that could be helpful with that. I think also I'll add to, a properly constructed NDA is also important. There's a lot of different ways to construct those. I think if you write them and construct them the right way, then it makes them not only more enforceable but also have more teeth and ultimately allow effectively remedy and relief to come quicker. Again, full disclosure, we're not attorneys, but we certainly have a number that we could refer people to and work with very frequently.
We have another question from Rika. How do you determine the valuation of your business? I would suggest you guys all check out the valuation tool that Global Wired has on their website, globalwiredadvisors.com. It's pretty cool. It gives you a pretty, it breaks down and gives you the valuation. But can you guys kind of tell us how is it best to determine an initial estimate?
Well, it's just as you said. I would go straight to the valuation tool on the website, globalwiredadvisors.com. It will walk you through the different components that are necessary for a preliminary valuation. I'll add, though, that the competitive advantage intangibles can move the needle as well. I think that the valuation that is derived on the website is a great starting point. But ultimately, once you have that starting point, it's probably best to set up some time for a consultation with us, and we can walk through those competitive advantages that you have that could move the needle more favorably.
This is from Pete, what are some 3 to 5 business attributes, this is a big question, that contribute most to increasing valuation multiple?
Well, I'll start there. I think I'll give you a couple. First of all, kind of Joe referred to the idea of a moat, and a moat is somewhat multifaceted. But what we're seeing, kind of within the idea of building a moat, which always has a positive effect on multiple, would be competitive advantages around brand. So developing your own brand, having brand registry, having IP around your brand. I'd say that, building, relationships with suppliers that are unique and difficult to really copy or really repeat are 2, I'd say right there. I think that, showing consistent growth is another one that is very important. time, and the longer you are in business, I'd say that's always important. The longer, the better. Gives a buyer more data to work with. And I'll also say too, and then I'll let Joe jump in here, is and this isn't necessarily under someone's control, but it also kind of is, and that's around category and industry. I'll give you a good example. A category that has been very hot for the last couple years and remains that way would be pet products, where understanding if you're going out and you're going to add to your product portfolio or look into diversifying across category, understanding the categories that buyers are paying more for is important.
Yeah, and I would add scalability, the ability to add additional products and grow your business. And I would also add the ability to defend margins. That's somewhat related to the deep moat, but as you grow, are you able to expand margins, take market share, and defend that gross margin?
All right, next up is Susan. She had a situation where she had an unavoidable out of stock situation and then some copycats moving in. She now has a patent and Amazon has kicked all those copycats off, but it caused earnings to decline in year 2. So what happens to her if she goes to sell?
Well, I think I'll say one thing with that. We've actually had a couple of situations like that recently where there were, I'll just put them all in the category of short-term disruptions to the business that ultimately were resolved, and they were no longer a problem. And really, that will come back to the uniqueness of the circumstances. How easy is it for us to explain to a buyer what happened? I think it always is good to put a little distance between the time that occurred and the time that you're going to go to market, at least maybe a quarter or two, so you can show that you're back on track. I think that's also very important. And then, also again, understanding and doing what she did is great. Having the patent to sort of protect yourself from a repeat in the future. I don't know if you'd add to that.
Yeah, definitely. And it's like we mentioned before, buyers are interested in what your company is going to do going forward. If you have a good explanation as to why revenue dipped, and you have a solution, for the go forward picture, then it's not as big of an issue. If we can explain it, in other words, it's not as big of an issue.
All right, moving along here. Next up, we have, what about selling off a portion of your private label listings? This is from Anthony.
Absolutely. We can absolutely do that. I think it gets a little tricky, because if you have one company and you're selling and you're basically carving out individual products, it's like a divestiture, but we're not selling a company per se. So we would have to think through what the legal structure would be with respect to that carve out, and it's not a big issue. It can certainly be done, but there might be an extra step or two with respect to going to market.
And I would just add to that, the ability, doing that is a lot easier if the business owner has the ability to carve out financials that would be specific to those products. So effectively, carve the company into two pieces and be able to show an accurate profit and loss statement on just the piece that's being sold. So the ability to accurately do that would also play a large role in how successful we could be with it.
So if you're interested in possibly selling some of your listings, get your books in order, keep things separate based on how you would sell them together.
And think it through. And I think the key is to just think it through and understand that if you were forced to produce a separate set of financials for just the products that are being sold, would you be able to do that?
Okay. Is there a suggested legal structure of your Amazon business before selling? So S Corp versus LLC, or should you consider changing that structure prior to a sell? This comes from Matt.
Well, there's really, from the standpoint of going to market and selling a company, there probably isn't necessarily a preferred legal structure. We see more LLCs, and in the sale process, that leads to basically an asset sale where an acquirer will come in, they'll set up a new company, and all of the assets of the old company are effectively moved over to the new company. If you don't have an LLC and you have a corporation, then the sale process may look a little bit different. It could look like a stock sale where everything in your company is transferred via the sale of the stock in your company. It doesn't necessarily have to be that way. It could still be the movement of assets from the existing corporate structure to a new co, but it's a little bit more involved. So I guess if I had to choose a given legal structure to start with or go to market with, probably I would choose an LLC.
This comes from Leanne. Do you recommend a minimum value of company before looking to sell it?
Well, I'll answer that one. I think it's, from the standpoint of, is it worth going through the time, worth going through the we'll call it the process, it's rather involved. And there's, certainly fees and expenses associated with selling your company. I think you want to have a critical mass where it's worth it. Now, for an individual person or owner, how much ultimately they would need to receive in a sale for it to be quote unquote worth it is an individual decision. I mean, we've seen businesses in this arena in the Amazon business world, sell for as little as a few $1,000s. I mean, they're sold down at that level. I would question certainly whether something like that is worth the time and expense to go through. But I wouldn't say there's a hard minimum. What I will say though is, in terms of supply and demand, certainly recently we've seen, kind of a fairly large supply of smaller, we'll call it, enterprise value of under $200,000, let's say, businesses coming to market. And so if you're in that category, it's just becoming a lot more competitive because you're selling your company and there's a lot of other people in that category selling as well. And so, it's a supply demand dynamic where, you have more sellers to compete with than if you were a little bit larger.
Can you give us an idea? This is from Susan, from the initial beginning of, hey, you wake up, I want to sell my business, to all the way to that closing date when you're sold and done. How long does that typically take? We
like to tell sellers somewhere between 2 to 5 months. And, that may sound long, but again, going through the process correctly is going to allow you to achieve maximum value in a sale. Okay.
All right. Jumping into our chat. So those are questions that we had during the webinar. Now I'm jumping to our chat. Michael asks, can you give a rough range of multiples and how do you deal with inventory value? Is it added to the multiple or part of the multiple calculation?
Well, let's call it the rough range of multiples is 1 to 20, let's say.
Yeah.
And I'm saying that half jokingly just because, what we have seen is a pretty wide range. Now, there does tend to be a cluster around kind of the 2 to 4 to 4.5 times SDE, which is something we talked about in the webinar. That's where most of the businesses are clustered in that group, kind of between 2 and 5 times. And there's a lot that goes in to determining whether or not you'd be closer to 2 or closer to 5 or through 5 or maybe even under 2. As far as the inventory value goes, what we see oftentimes is, businesses that sell for under $1 million, usually the price, the selling price would be the multiple times the SDE, and then inventory would be added on top of that. What tends to happen with larger transactions that are geared towards more professional buyers, those professional buyers are used to, in a consumer products or a retail type of a deal, there being a certain amount of inventory that's included with the sale. So there'll be sort of a base amount that's marketed as part of the deal. There's a little bit of feel and art to that as well, and I think we always make that decision on how we're going to market it, with or without some inventory included in the price. Ideally what ends up happening is you end up at the same place anyway. It's just a matter of whether or not you're paying a higher selling price with some inventory included, or maybe a lower selling price with inventory added on top of it. But for smaller deals, we see the inventory just as a pure add-on. But as you get larger and larger, buyers are just used to some kind of a base amount of inventory included in the sale price.
Okay. Do you sell private label brands separate from the seller account, or both together?
Well, technically it's all together. But if you're going to do something like we mentioned before, where you're trying to divest a brand or divest a certain product set, then we would have to, kind of transfer that separately. So the product, information and feedback and all that gets transferred, whereas the seller account itself does not.
Okay. And that was from Rosemary. This is from Hunter. What is the typical difference between the first offer the buyer agrees to and what they agree to after the review before closing? He's asking in percentage.
Well, it really depends. It really depends in large part on how thorough you have put together offering material. The due diligence process can in fact move valuation. As buyers come in and they understand a little bit better, more about your company, they can make determinations that their original valuation wasn't accurate, right? So as you go through the sale process, again, it's very important to lay out all of the details in a very succinct way, so you don't have that surprise. So if I had to guess what the percentage was, I would say that it really depends on largely who takes you through that process. Is how I would.
Right. I think the key with that is if you do the work up front to make sure that all the numbers are vetted, and that's again something that would fall on the advisor, then you don't have a lot of moving around of that number. And that's another thing too, from an advisor standpoint. If you design your process the correct way and you run it the correct way, if a buyer effectively, as you move towards closing, tries to pull a fast one, let's call it, and try and retrade you, is what we call it, then our job is to hold the line and tell them, that's not going to happen. And by the way, you won't work with us ever again now that you've tried that.
Yeah, that's right. Yeah.
This is from Mary. What is the range of businesses? Sorry, I'm trembling. And sorry, these questions sound all over the place, but we're just moving in order. This is from Mary. What is the range of business values that you sell?
Well, we'll sell, companies that have values as low as $300,000 or $400,000 up to, I think the current engagement we're working on right now is close to 60 million. So it's quite a large range, and across all different industries, all different sectors, all different products. But that's typically, I guess, the valuation range that we would work. It's quite large.
Okay, so this next one is from, let's see, sorry, I got a little lost here. Sation, does having multiple channels selling, such as Walmart, Wayfair, Overstock with the same SKUs as on Amazon, does that add to your value as a company, as a business?
Yeah, shorter answer would be yes. In terms of, diversification of channel is almost always a good thing. The devil is a little bit in the details with respect to, what's the profitability of those channels. For example, and this is rare, I don't think I've seen this, but if it did happen, let's say that on Amazon you had good margins, but on another marketplace, your margins were very poor. Well, in that case, the diversification really isn't going to help you very much. But assuming relatively consistent margin across the channels, then diversification is typically, I'd say, in almost all cases, treated as a positive by a buyer and should ultimately contribute to, either value or overall interest in buying the company, or both.
All right, next one from Christina. If we sell in retail, good for you, as well as selling online, could you sell the whole thing, or could you keep that portion of the business, or would we keep that portion of the business?
You could sell it as a package. We can absolutely help you with that. You can carve off the online business and sell that separate, or sell the retail business. It's entirely up to you, and we can help you structure that in a way to, again, accomplish your goals in the sale.
Yeah, and I think too, I'll add that, the only place that becomes a little bit difficult is if you have to have, intercompany agreements. So let's say that a buyer is buying the right to sell a certain product online only, and you retain the right to sell it in retail. There'll just have to be an agreement put in place between the buyer's company and your company as far as how the future, who has rights to what going forward.
This comes from Frank, what would you recommend as the minimum traction in annual revenue a seller needs to have before considering a sale?
Well, insofar as sales levels are concerned, they really vary. It's, as we mentioned before, a primary driver in valuation is going to be seller discretionary earnings. So seller discretionary earnings are going to be calculated from top line revenue, cost of goods sold, expenses, add backs. So a given revenue level isn't as good of a proxy really as seller discretionary earnings. And, as Jason mentioned before, just as a rough estimate, whatever your SDE, your current SDE is today, a multiple of 3 or 4 on top of that is going to give you a valuation which, hopefully will be above that $400,000 or $500,000 threshold. Insofar as
This is from Adam. Can you sell multiple seller accounts as one group bundle?
Yes, absolutely.
All right, next, Rosemary, how long typically does the seller remain available to assist the buyer after the sale?
It really varies. It really varies on the agreement that you work out with the buyer. Some buyers are going to want to have you around for a while, and they may in fact offer you a consulting agreement that lasts a year, up to a year in some cases. Other buyers may know the space. They may know how to operate more effectively out of the gate, and they may only require 2 or 3 months. It's a point that you can negotiate in the sale process.
And it's a fun thing too, because you can either decide, hey, I want to stay here and be part of the company and a big part of the transition, or you can say, hey, you know what? I got a big payout. I'm going to just be retired for a little while and just enjoy life. And that's what I think is so much fun about this topic and talking with entrepreneurs and business owners, because they've built this and now they're getting ready to sell it and either, start something new or just take some time off and enjoy life. We're going to fit 2 more questions in. We've got Clasina. She's asking, is QuickBooks Online method of expense accounting good enough?
It is. It is. A QuickBooks-based financial picture is what most buyers are going to expect. Most buyers are going to, in the due diligence process, pour through your QuickBooks files that you download and provide to them from online or from the desktop version to determine, technical difficulty, sorry about that, to determine whether or not the stated financials and offering materials are accurate. They're going to look through them. They're going to tie them to bank statements. But the short answer is QuickBooks Online is fine.
And we are going to end with Rosemary. Are most sales 100% cash or seller financing or other?
Most sales are a combination, and it really kind of depends on the size of the company that's being sold. What we see oftentimes is smaller companies will be all cash deals. When we get a little bit larger, when we get above 1 million in enterprise value, you start seeing financing involved, whether it's through SBA or through the seller providing a note, providing financing. It could be a combination of all three as well. Every structure is different. And that is part of the process in evaluating who the right buyer is going to be for your company, is not only the enterprise value that they're offering you, but also the structure that they want to execute the transaction in.
All right, I just want to thank you guys one last time, Jason, Chris, Joe, and Chris. Thank you guys so much for joining us. Thank you for all the information you shared with us. Really, really appreciate you guys on giving us just a good education on selling your business. And if you guys have any other questions that we didn't get to today, you can email Chris, cs@globalwiredadvisors.com. And if you are also interested, if you want more information on just some of the other topics we've covered, you can email me, Kate@AmazonInsiderPodcast.com, and I will send you all the episodes that we did with Global Wired Advisors. Thank you guys so much.
Thanks,
everyone.
Kate.
Have a great day.
Great,
Thank you,
Kate. Thank you. Yep.